What's up, guys? Today we are talking about something that is really important because there's so many questions around it, and I think that a lot of people don't quite understand if small markets are a good thing or a bad thing. And I hear this on both sides of the tables. People saying small markets are the way to go, and other people saying you should always avoid small markets. So which is it? Well, that's what I want to talk about. And this is a really important subject because that's where I got started. I got started in small markets, and for a lot of people, that's where they can get into the market. And what I mean by that is that is where their opportunity lies. And it can lie there for a few reasons. So before we dive into the nitty-gritty, if you could like and subscribe this video, that would mean a ton to me, and it would help us keep producing this content because it shows us that you like it. So like and subscribe, and we'll get going. I'm waiting. Okay, now, the good thing about small markets, that's how we're going to start this out, because small markets, I think, have some great pros, like really good pros. That's why I started in them. Now, the pros, though, and the cons can be unbalanced, I guess is a good way to say it. So the pros really need to be weighted in with the cons, because the cons can be severe. I think the best pro to a small market really is the low barriers of entry. There are smaller facilities, there's not as much competition, and the competition there is generally not that great. Now, this allows you to do two things, okay? So I got to break this up so we understand what we mean by opportunity. Opportunity is twofold. First of all, opportunity as far as inventory to acquire. There are lots of small facilities in smaller markets across the United States that are completely overlooked. Also, that inventory is not being chased by institutional money. That inventory, those smaller markets, big boys, they're not going to buy it for two reasons. First of all, the market is generally smaller, but two, the facilities are generally smaller, so it's not worth the squeeze. But that allows a lot of mom and pops to sell their facilities to other normal individuals that are looking to get in the self-storage market. So that's the first part of the opportunity of small markets. The second part that you need to focus on is the competition. Usually these facilities are being ran very poor. It's kind of a side thing and they're ignored, and it shows. This creates a lot of upside opportunity. We made a lot of money doing this, and it created fabulous options for us to move up into bigger markets. It was how we got into the game. And when I say small markets too, I'm talking small markets, which we'll get into later, the cons of that and why you need to be careful. But we went into markets where generally there weren't a lot of buyers. In fact, some of them there weren't. And I got some great advice from a gentleman that said, you need to remember when you're going into this market, not only is there not a lot of buyers, but there's a good chance you are the only buyer. And that puts the chips on your side, right? That gives you leverage, so to speak. That allows you to dictate more the contract and the price. It limits the options of the seller, right? If I'm going into a big market and I'm going to buy a 100,000 square foot facility, I'm competing with everybody. I'm competing with funds. I'm competing with REITs. There's a lot of demand, and those assets are worth a lot of money. Those sellers usually have a lot of help. Brokers, a lot of people want to sell that facility because everybody's going to make money off of it. And they're going to put a lot of time and effort into it. And they're going to try to get the highest price possible. When you go into a small market, that's not true. Not everybody's going to make a lot of money. There's not a lot of professionals in the area. The valuations usually aren't very good, and the facilities aren't being ran very well. All those things lead to opportunities to buy and turn around a facility and get great cash flow. That's why I like them. And that's why I thought it was a great place to start. The competition in the markets are generally not there. And because there's less competition, less buyers, less help for the sellers, that leads you to be in a position where it's more of a buyer's market. You can dictate terms that are beneficial to you. In fact, this is the area where I see people getting owner financing, right? I got owner financing in these small markets. That's one of the benefits. So now, first of all, all this sounds amazing, right? Everybody's like, well, why doesn't everybody do this? Owner financing, bad competition, better buys, lots of inventory. So these are all amazing things. Let's talk about the cons. All right, the cons are more important than the pros because the pros is upside, right? The pros is opportunity, but cons have to do with after you've bought it and what could go wrong. That is extremely important because now we're talking about risk mitigation. Now we're talking about real financial harm, so to speak. This is where small markets can get in trouble. Small markets, their supply and demand can be very fragile in two ways. So let's go over the supply and demand problem with small markets. The first problem with small markets, supply and demand, is simply the economy as a whole, as in it's very concentrated, almost always. It's concentrated on one industry, one employer. That can be fragile. Bad economies come, small markets usually suffer really bad. And demand can falter. And you usually can't get higher prices, right? And so you could be stuck in a position where not only is the market contracting, it's shrinking because a big employer went out of business. Now you're stuck with an asset that vacancy is climbing, you're getting lower rates, and now that the market's contracting, nobody wants to buy it. Remember how I said there was no competition to buy the facilities? That's a pro. That's also a con, because when you want to sell that facility, there's not a lot of buyers. This is why it's so important in small markets that cash flow is just absolutely king. It's all that matters. All you do is look at it on a cash flow basis. I do not attribute appreciation in small markets because you really can't. That's something that I hope for, and I get appreciation by increasing the rates and doing my value add. But long-term appreciation is very little normally in small markets. When I'm looking at that problem, that becomes a problem once again when things go wrong. There's no one to bail you out. There's no one to come in and buy that asset. And that can be a very risky and scary proposition. How you mitigate these risks are by looking at small markets that have a diversified employer base, that has a reason for people to come there, that has some kind of growth, right? It doesn't need to be blowing up, but I do want to see small markets that are growing. I don't want to see ones that are stagnant or shrinking. Those all fight against you. Remember, we talk about economic wins, and economic wins are the things that drive your success, that create opportunity, that create financial success. Those wins can be for you or against you. And when those wins are against you, it's a losing battle. So I do my research and I try to make sure that the economic wins that are prevailing in those markets are ones that are going to push me forward. It doesn't have to be massive, but in 10 years, that market better be bigger. There better be more demand. So that's the first part. That's the high level, right? Actually, the problems with those markets and how to avoid them. Diversified employer base, and growing trends, right? Both in income as well as actual population. Those are things that we look for. The second problem, though, with small markets is the competition, which once again, I know you're sitting here going, AJ, hold on. You literally just said that the competition is a pro because they're bad and they're not as good as you see in first-tier markets. So how can that also be a con? Let me explain. Although it's competition, it has really more to do with, once again, the demand. In self-storage, everything is demand. So you get somebody in a small market that comes in and builds a brand new facility. Remember, about 10% of the population uses a storage facility. So let's say that population is 10,000. Right? That means in general, you have 1,000 people in that market that's utilizing storage. Well, if somebody comes in and builds a facility that has 300 units, that's 30% of the demand. Obviously, I'm making these numbers up, but you get the point. We see small markets that people are looking at building in, and they look at the total square footage on the market. This is what I run people through, right? So whether it's in our inner circle, self-storage income's inner circle, or whether I'm just talking to people, I take and I look at the market as a whole. So an actual example, let me use an actual. I was looking at a market that had 150,000 total square feet in that market of storage available. Somebody was coming to me and they said, listen, this market's great. They're all 100% occupied. The rents are going up and there is growth to the market. We're going to come in and we're going to build a facility. And we want to know what you think. And we want to know if you think we can fill it up. The facility was roughly 80,000 square feet. Now, remember, that market only had 150,000 square feet in it. So although everything pointed to strong rates, population growth, that's over a 50% increase in inventory on that market. Well, can that market sustain that kind of inventory? I don't know. And it would be ridiculous for me to assume if it could or not, because that is such a substantial increase to that market. There's no way that I can really measure that kind of demand. But people do this all the time. They'll go and build 50,000 square feet. Now, if you're in that small market and someone overbuilds, they flood the market with supply, right? Basic economics. There's not as much demand. Vacancies go higher. There's less that you could charge for those units. But that's not even the real problem. See, the real problem is that it could take years in a small market that's not growing, if ever, for the market to saturate that square footage, to actually utilize it. So if you're in a market and somebody builds a huge facility and there's no demand for it, if that market's not growing, why would it ever fill up? There's no new demand being created. These are eroding valuations, right? So your values in those markets just keep going down because there's no prospect for it to go up. And you're discounting your rates, your income's dropping, your vacancies going up, delinquencies are harder to get a hold of because if you just kick somebody out, there's nobody to fill it up. So now you're trying to get people to pay and you're trying to get collections made. This all has a downward trajectory on revenue. And self-storage is based upon cap rates, which is done off of your revenue minus your expenses, net income. That's what cap rates are based off of. So if your revenue's dropping and you're doing now more marketing, more effort, that means expenses will generally be more because you have to spend more to get more customers. Your net income's dropping. That makes your valuation go down. This right here is the principle of that eroding value. And this is what you worry about in small markets. So summarize this video really quick because it's important that you understand pros and cons. Are there pros? Absolutely. Self-storage is still relatively non-competitive in smaller markets across the United States, and there's opportunities all over the place. But is there dangers? Yes, there are. You really need to understand that market, the market overall, but also competition. One of the ways that I'm looking for in a facility that's small, I go to the city and I ask, what land is designated for the use of self-storage and where do you allow self-storage? Is there anything permitted? I need to understand if the future demand is going to change. And you never want to use a lot of debt in those markets. Remember, cash flow's king. Keep high cash flow and reinvest it. Don't overburden yourself in expenses and debt in case that market changes. Hope that helps.